I am John Haig. I am the co-director of the Mosavar Rahmani Center for Business and Government. It's terrific to see so many of you here. It does make me feel like we are in many ways back in person, which is really, really very nice. I also know that food is a good attraction for students. But having said that, I know that Carmen is an even bigger attraction. There are chairs back there that you can lift off and to sit. I apologize if some of you end up having to stand. I'm going to introduce Carmen really quickly, and as soon as we can get to her, the better off we all are. So she is the Minos A. Zombanakis Professor of International Financial Systems here at the Kennedy School. We were very fortunate to get her a few years back. She's a former senior vice president and chief economist of the World Bank. And she assumed this role on June 15th, 2020. So she's been away from us for a couple of years, just came back this fall. So we're terrifically happy to have her back. And she also managed the bank's development economics department for a while at one point. She was senior policy advisor and deputy director at the International Monetary Fund and chief economist of the investment bank Bear Stearns. So she's kind of touched like just about every kind of institution, from the IMF to the World Bank to a private bank, and has really terrific perspective on those dimensions. She currently serves, I think you still serve on the advisory panel for the Federal Reserve Bank of New York. So again, another institution that seems to be in the paper a lot right at the moment. And generally she's focused on financial crisis. I still have her book that I pull off on occasion about This Time is Different that she wrote with Ken Rogoff. And terrific book. I would advise reading it if you get a chance.
That could be ironic title, by the way.
It was ironic. It was like, yes, definitely. And so she's got a tremendous number of scholarly articles that I would encourage you to look at and dig up. And with that, I'm going to hand it over to Carmen.
Thank you, John, for that wonderful introduction. I'm really very much looking forward to having a conversation with you. I'll plan to talk about half hour. First, let me tell you a little bit, sort of framing what I'm going to talk about. I went to the bank, and I'm very happy here at the Kennedy School. So the bank literally had been after me to, get me over there. And I really went there because of COVID at the beginning of, which is because it made it really compelling to be at an institution that, is sort of at the heart of development. And the multilaterals stepped up their game during COVID, as many of you know, historic surge in lending, activity on every front. And so that made it very exciting for me. And it's sort of like Dickens said, it was the best of times, the worst of times. And I'm going to talk about the worst of times. So, if you brought tissues, this is a good moment to get them out. Because I will caveat things, right? Because talking about developing countries, which is lower to lower income, and talking about emerging markets, which is middle upper incomes, encompasses, as I don't need to tell you, huge heterogeneity. You have countries that in those groupings that are doing quite well, stably, given global conditions. Others are already in deep crises. Others are somewhere in between. And I'll caveat things. So remember that when I talk about these groupings, I am going to be, aggregating across very different countries. I started this project with Eduardo Laverria, who was a former student of mine at University of Maryland decades ago. And he's was a PhD student and now works at the bank. And what I'm going to present to you, I presented the Nobel Committee in Stockholm did a seminar in late May focused very much on COVID and COVID aftermath and development. So it wasn't about so much, COVID and the advanced economies. There was an element of that, but the big focus was, and certainly, my overview was here's what COVID has done, but before we get carried away, let's not attribute it all to COVID. And that will be one of the big points that I will also, but this lecture, along with a short blog that I think you all received, are part of an ongoing work because, and this is my last remark before launching into the presentation, as chief economist at the bank, what I was hearing from different quarters is that the people that were working on ag issues, agriculture and food security, we're seeing big setbacks because of the lockdowns, the intermittent lockdowns, disruption to supply chains, all kinds of setbacks. The people who are working on human capital, which involves education, health, also a lot of gender issues, we're seeing major setbacks because during lockdown, kids, lost a huge amount of schooling. The people who were working, which was one of the projects I supervised, the Poverty and Shared Prosperity report that the bank puts out, were saying, well, look, 2020 marked the first increase in global poverty since 1998. Okay, poverty had been in and I'm going to talk about this, poverty had been in a downtrend, and 2020 marked the first increase. So given that this was coming in from so many angles, I said, this is a bigger picture. This is cross-cutting, and this is what became the reversal problem. And it's a reversal to some of the development advances that we had seen in more prosperous periods. This is the setting. And, I'm a macro finance person, okay? So I come in from that angle, and I drew on my colleagues from other disciplines to fill in also critical areas, including on the political economy side. So, I'm going to talk about a lot about income levels, the difference between rebound and recovery, which is an important concept to understand. I'm going to talk about inequality within country and across countries. I'm going to talk about different measurements of poverty, quantitative and more qualitative. I'm going to talk also a lot about, this is what occupied a huge chunk of my time at the bank, dealing with the high debt levels, countries and countries that are in debt distress. Just, people hear, oh, the hypothetical debt crisis. No, it's not hypothetical. Actually, if you look at the 74 countries that were eligible for the debt service suspension initiative, and I will talk about this in case you're not aware of what it was. The debt service suspension initiative took place from early 2020 to December of 21, and it basically suspended payments to creditors that participated from debtors so that they could use, so those countries, it only applies to the 73, 74 poorest countries, the lower middle income and low income. But let me say that that group, those 73, 74 countries, more than half of them are already either in debt distress or near debt distress. So it's the issue is not a hypothetical one. I will talk about that because that also took up a lot of my time when I was at the bank. The issue, the nexus between the political economy and economics is hardly new. And so what we're also seeing is some worrisome trends also on the reversal of democratic institutions and democratic values. Circling back I am going to also to talk about very much forward-looking now, the role of credit ratings, sovereign default list, also going forward. For many of you who are following the big debates in financial press, the big debate, of course, is about what will happen with US monetary policy, ECB monetary policy after decades of declining interest rates, fairly accommodative monetary policy. We've had a reversal with inflation spiking pretty much globally, and I'll talk about that. So this also has bearing on foreign direct investment, the perception of risk, and certainly conclude on the hot topic of the day, which has to do a lot with inflation and food prices. Food price issue is less of an issue for advanced economies. I see, I talk about inflation and the lights flash, So I also worked on the issue of food crises while at the bank, and that's a big issue after the Russia-Ukraine war. This has not really been an issue for upper income countries or for middle upper income countries, but in the lower half of the income scale, there's a lot. So that's a detailed roadmap, and now I'm going to launch into it. But let me be very clear what the reversal problem is about, and why we call it the reversal problem. During COVID, and this was part of the sort of big first chart in the World Development Report that I directed last year. If you look at all the countries that have time series for per capita GDP, and going back to 1900, just 120 some years, okay? And you look at, simply put, the series on per capita incomes and tally the number of countries which had declines in a particular year. The year 2020 had the largest share of declines. 90% of countries had declines in per capita GDP than any year. World War I, World War II, the Great Depression of the 1930s, which peaked around 83% of the countries. And so, that was an eye-opener for everyone. But we argue that, yes, this COVID was sort of was cataclysmic and was encompassing and very visible, but the setback to development was already underway. And this is of significance, right? Because what COVID did was add basically what is commonly put as insult to injury, that it exacerbated what was already a troubling trend. And for many countries, that beginning of a slide begins, and I'm going to put this in historic context because that's really important for you to understand. Development is not something that you talk about, oh, we developed in the last 3 years. That doesn't, development is a long-term process, as you all know. The backsliding began around 2015, and I'll explain why in a minute, okay? And as I mentioned in my roadmap, this is encompassing. This is a broad array of indicators. It's not just economic indicators, financial indicators, it's social indicators, it's political indicators, indicators of also the quality of institutions. And so we argue that these trends you know, there is no cookie cutter, no one size fits all, but they tend to follow a U-shaped pattern from, or, you know, depending on the indicator, a reverse U. We'll talk about that. But from better, very far off, we're not gonna, you know, we're not gonna talk about the 70s, we're not gonna talk about the 60s, but from really bad to better and back to bad. Not quite fully as bad as before, but so it's moving from emerging markets and developing countries as a group. Many of them move from you know, a problem to progress to stagnation and then to reversal. Okay, so if you look at the middle income countries, it's not quite as overly dramatic, but this is pretty dramatic. And they're all, this is just straight per capita income, okay? And this is important that you get a time dimension here. This is the notorious debt crisis of the 1980s. I was at Bear Stearns at the time. I was a baby, and 6 months after I started, Mexico defaulted. And after Mexico, everybody else started having increasing difficulties. Not everybody defaulted, but and by the way, many African countries were already in default by August of 1982 and 1980 and 1981. And so what you see here is this is a massive setback in the start. Look, per capita income is not a panacea, but it correlates like crazy with a lot of indicators, from health indicators to, you know, things like child mortality, to calorie intake, to all kinds of, so it's not a perfect indicator, but it correlates with a lot of stuff we care about. And this is a massive setback here, okay? So the setback was what we call the triple whammy. You had a spectacular increase in US interest rates. Does this sound familiar, right? This is in October of 1979, Paul Volcker, then Federal Reserve Chairman, hikes rates in the US to all-time post-war highs in response to inflation, which had been climbing to close to 13, 14% at the time. And that for countries, remember, developing countries, and this is true in varying degrees, okay? Brazil is in one end in which they have a lot of domestic currency, domestic held, domestic law debt, but most countries have a lot of dollar debt. And those dollar debts are held by non-residents, owed to non-residents, and carry international interest rates. So when US rates go up, the interest rate on those debts go up, the debt servicing burden increases rapidly. We're going to talk more about that. But so you had a hike in US rates, you had a crash in commodity prices, okay, which we had in 2020, but as we know now, commodities have rebounded importantly. Many commodity producers, especially in Africa, especially in Latin America, are very commodity dependent. So their cycle is very tied to the cycle of commodities. You know, during this period, from the early 80s to about early 1990, most of the middle income, many of the middle income countries were in default. And, you know, they didn't have access, they couldn't borrow. So this was a major setback for growth. And I'll speed up so that, you know, we can, and average per capita GDP fell And for low-income countries, for the middle-income countries, the Brady debt restructuring was a big deal from 1989 to early 1990s. For the low-income countries, they were not part of the Brady deal. Their debt relief came much later during what is called the HIPIC initiative, the Highly Indebted Poorest Country Initiative. And that was late 1990s. It was introduced in 96. And so there's a continued slide here. And then you see recovery. And then everybody gets very excited. Emerging markets, developing countries are doing great, even during the global financial crisis. And I get interviewed a lot. I was talking to Bloomberg the day before yesterday about an article that they're doing on tail risks. And one of the, they issue global recessions and so on. Look, in a snapshot, global financial crisis, 2008, 2009, engulfed the US, engulfed much of Europe, engulfed Japan. It was an advanced economy crisis, but China was booming. And with China, there were big externalities, positive externalities for emerging markets and developing countries. So you had developing countries catching up, and we see this with the advanced economies, both because they were doing much better, but also because the advanced economies were in recession, and it was a long, protracted recession. The concern going forward is we ask, who's going to be the engine of growth? Okay, that's an important, we can discuss that later on. But we are not where we were. Now, I talked about the aftermath of the global financial crisis as a period of convergence, where emerging markets and developing countries were doing comparatively well relative to advanced economies. And so, they had some catch-up. Countries like China had a spectacular catch-up, others much less pronounced. It was uneven. COVID changed that. The COVID shock and the recovery or the rebound from the COVID has been very, very skewed. Advanced economies, and let me just be clear on what Vincent Reinhart and I, at the beginning of COVID, did a piece for Foreign Affairs that, made the point, do not confuse rebound with recovery. If you have a 10% decline, and that's 2020, and in 2021, you have a 10% increase, you're still worse off, because 10% of a lower base doesn't recoup what you lost. And so there's a tendency to get, oh yeah, recovery. But when you look at per capita incomes, the share of countries that recovered the fully, so that 2021 was a new peak in per capita income. For the advanced economies, it's 37%. By the time you get to the middle income countries, it's 27, and by the time you get to the low income countries, it's 19. Okay, which means, put differently, that more than 80% of countries still have, and the 2022 data is, even though the World Economic Outlook is going to come out next week, it's all estimates, okay? Because especially for this group. Okay, what's worse is that many countries, 1919 is not the right comparison, because 1919 was not their peak. Countries, big countries like Brazil had peaked in 2015. And when commodity prices crashed in 2015, many commodity producers took a big hit, and they started a gradual process of contraction. So bottom line is COVID really widened the gap again between developing, the developing world, and the advanced economies. And a reason, not the only reason, but a reason was advanced economies had a lot more resources to respond to COVID. Fiscal policy became very stimulative, monetary policy became very stimulative. When you go down the income ladder, you see less of a fiscal response because many of them were already having debt problems, many of them didn't have fiscal space, and for a variety of reasons, they could not pump stimulus into the economy during the COVID pandemic in the same manner. So surprise, surprise, here's the global Gini. You know, as measured by the global Gini index, income inequality across countries had been steadily declining through 2015. Remember, 2015, there's a lot of moving parts around there. China growth slows down dramatically in 2015. This is when we went from, you know, China's growth rate between early 2000 and 2013 was over 10%, double digit. It ratchets down to about 6% around 2015. Commodity prices crashed. And as a consequence of the commodity crash and the slowdown, a lot of countries begin to see recessions and also risk premia start to go up. So and this is why I'm repeating myself, but I'll be very quick about it. We describe the reversal problem as one first of stagnation and then of reversal. So between 2015 and 2019, we weren't getting real worse. You know, some indicators did get worse, but it wasn't dramatic. And then with COVID, and now the Russia-Ukraine war, which I will also talk about, the reversal was much more dramatic. Now, this is based on the subset of countries where we actually have reported Gini for 2019 and 2020. There are no estimates as yet for 2021. Those are really in progress still. But for the most part, what you see is that while inequality pretty much worsened for most countries, the middle income countries saw the worst gaps in income, the biggest increase in inequality. Many emerging markets, this was true in Latin America, not unique to Latin America. You also saw it on a more scattered basis, but you saw it in Africa, sub-Saharan Africa, not so much in the Middle East, but you had seen a trend towards better readings of the Gini coefficient. I don't show them here because the number of countries goes down as you try to get historical Gini data within country. But many of them had seen an improvement in inequality, and that gets reversed. So there is across country inequality, rise in inequality, and within country. And surprise, surprise, given what I've shown you so far on per capita incomes and on Gini coefficients, poverty rates, and we can get into the nuts and bolts because there are quantitative measures of poverty, qualitative measures, they all point in the same direction, okay? Question of orders of magnitude. Poverty rates, which had been dramatically declining from 2000, especially to 2015, then begin to stagnate and actually reverse in 2020. and they're going more in that direction. The Poverty and Shared Prosperity report is due to be out by the World Bank very soon. And so the share of low-income countries that had and emerging markets that had an increase in poverty relative to the previous 5 years, surprise, surprise, it's had its highest level since we have the poverty data, the detailed granular poverty data. One thing that you'll be hearing a lot about, because this is not my area, okay? I'm not an education expert, and so I relied on my colleagues at the bank who were doing in-depth studies of this. But educational setbacks have been really unprecedented since the data is collected during COVID, because, you know, on average, you know, the loss of schooling, you know, was Uganda had the highest loss of school days, but the cluster was still over 1 year. And interestingly, the biggest losses of poverty are not among the lower income countries, but the middle to low and the middle high. Because I know this is going to sound terrible, but what the data suggests, that the initial quality of learning and schooling in low income countries was poorer. So you didn't lose as much as in the middle income country range, where the quality was better. But bottom line, these educational losses mean human capital. Human capital means medium-term growth. So if you're thinking about inputs to the growth equation, and we know, you know, anybody that's done any kind of Barrow type regressions on cross-sectional growth, we know that any kind of human capital indicator is usually a fixture in these things. Human capital is poised to be impacted by the pandemic for several years. And that also has bearing on the medium-term development concerns that I've been raising here. As I mentioned, this was the topic that I worked on the most. You know, I was the bank representative at the G20. I was involved in all the discussions of the countries also that are needing debt restructuring and so on. And the debt issue cannot be ignored in either emerging low-income countries or in the emerging markets. And this is, normally you look at debt to GDP, but I've chosen deliberately to show debt to revenues, because revenue collection has also suffered a lot during the COVID pandemic, okay? But what you see, this U-shaped pattern that I talked about, this begins well before COVID. And, you know, it is a source of concern we can talk about. When do we go on? 1 o'clock. Okay, very good. So let me just say a couple of things that is really troubling, and it sort of sets the stage for some of the conclusions or some of the worrisome thoughts that I'm going to lay out at the end. I mentioned that I, you know, was at the G20 sessions throughout the period in which the debt service suspension initiative came into being and was in place. And how many of you, you can be honest, okay, have heard of the common framework for debt restructuring? Okay, in a nutshell, common framework for debt restructuring was signed into action at the end of 2021, and it said the following. This is G20 decision, okay? Look, the debt service suspension initiative was about what is called in the jargon of debt restructuring, cash flow relief, meaning you are a country that applies for the debt service suspension initiative, the DSSI, and you don't have to pay your debt during that period. But when the debt service suspension initiative comes to an end, you start repaying, and you start repaying what you missed, right? It's a moratoria, and that moratoria allows you some cash flow instead of going to debt servicing to go and do emergency spending on, meeting the demands of the COVID. Okay, that was the debt service suspension initiative. Enter the common framework. This is relevant for when we talk about debt problems. The common framework basically says, look, if you have an unsustainable debt burden, by definition, it's unsustainable. So cash flow relief isn't going to cut it for you, because when the moratoria ends, you're not going to be able to repay. What you need is debt restructuring, which in the end is some form of debt relief, which means in the end, it's restructuring. And if you're interested, I do a financial crisis course that encompasses all these types of crises, from debt crisis to inflation to, financial fragility, whatever. But debt restructuring means that countries need better terms. So if you're borrowing at an interest rate of 8%, your interest rate to be able to service it, that has to come down. You have to have longer maturities, because you can't pay in 2 years. You may need 10 years to repay. That's maturity extension, better terms, or you may need a write-off. Okay, which means, okay, your debt is worth 50 cents to the dollar. Okay, now that's what the common framework is about. It is about those countries that are insolvent, that need, let me say that sadly, this was the end of 2001. Well, we haven't seen any debt restructurings yet, which is problematic, which is foot dragging. It is the same problem we had in the 1980s, which turned out to be known to many as the lost decade. This is a big issue for development, okay? So if you look at debt servicing, this is yet another indicator that debt to revenues tells you about a stock problem. Debt service to exports tells you about a cash flow problem, that you're spending a lot of your revenues. And why export revenues? Because what you export is where you get your hard currency, right? You can't repay dollar debts with peso debt, or you need a source of hard revenue. And importantly, debt service had been rising again, even well before COVID, notwithstanding, and this is a big point, hopefully, of discussion for us, notwithstanding how low interest rates were in the global economy. Now imagine with higher interest rates, what this may look like, because a lot of the debt is what is called variable rate debt, right? Which means that when rates go up, your debt servicing feels it immediately. It's like a variable rate mortgage, okay? And a lot of the less amount, okay, now I'm exaggerating, but a smaller amount is short-term debt, which when you roll it over, same thing, you get a higher rate, okay? So there's these issues. And by the way, I've written a lot, for those of you that are interested, I've written a lot on the hidden debt problem. I'm not going to go into it here because I want to allow a lot of time for discussion, so I want to wrap this up. But big point is these debt levels actually don't tell you the whole picture. And these debt servicing charts that I've shown don't tell you the whole picture. in my work with Sebastian Horn, Christoph Trebesch, and I, for the last, since 2017, so, you know, it's been a while, we've been documenting the underestimation of debts that of especially low-income countries' debts to China, because debts to China are not fully recorded in the official debt statistics. Now, surprise, surprise, we're going to turn the spear before we turn back to economic indicators to political indicators. You pick up the press, and there, if you really were to do an analysis of the press over, you know, the last decade, the last 15 years, what has become, I think, a factor in the last few years is more populism, more discontent, and you know, I was telling John before the seminar that I just finished doing a blurb for the book that Martin Wolf, which I highly recommend to those of you interested, you know, that are interested. He talks about basically the dance between politics and economics, and how economic disappointment has led to a lot of the trends towards populism and so on that we are seeing. His focus is more on advanced economies, but ditto applies to emerging markets. This is not our index, but Freedom House does publish an index that captures various manifestations of democracy, and you know, based on the 154 emerging markets and developing countries that they include, this is the outcome, which is basically the share of countries that have seen a decline in democracy, i.e. the share in the not free category had been rising. And again, this is not independent at all from the social and economic indicators, deteriorating performance we saw earlier. Given, you know, what do credit ratings do? Credit ratings assess risk, right? That's what they do. They assess corporate risk, and they assess sovereign risk. Sovereign risk can mean I can't pay, or it can mean I don't want to pay. Okay, and so there's elements of both economics, I can't pay, or in terms of politics, I won't pay. So because you know, obviously, confiscation has been a constant through history, although full debt repudiation is very rare, very rare. For anyone interested, I do have a paper called Sovereign Bonds Since Waterloo that looks at the issue of defaults over the last 200 plus years. So the same here now, it's a reverse U, right? You go from bad ratings to better ratings, back to worse ratings. And this is not really factoring in yet the full effects, because this is through 2021, the very end of 2021, the impacts of the Russia-Ukraine war, which for many countries, including advanced Europe especially, has meant higher oil prices, higher inflation, more stagflation problems, more potential issues in debt servicing, and big increases in food prices and food insecurity. So here is, you know, the meaning this is likely to continue this way rather than that one. And I'm very close to the end so that we can open up for questions. But surprise, surprise again, if you have deteriorating credit risk and deteriorating economic performance, more unstable political systems, less reliable, the prospects for attracting more foreign direct investment become dimmer. And many countries are in dire need of foreign direct investment, not just owing to recovery from COVID, but owing to needed changes that need to be made for their greening of their economy. Climate finance means big financing risks to fuel the needed transition. Adaptation takes money. Mitigation takes money. And so the financing needs are large. Now, importantly, I will flag that China, which was a major lender, Chinese lending to developing countries is bigger than the entire Paris Club official lending. Paris Club are the traditional, major OECD countries. Chinese lending to developing world has reversed. So they were big lenders, now there's repayments. And again, I flag the work of Sebastian Horn, Christoph Trebisch, and I. You're welcome to check out. We also did a blog on this in VoxEU. We have a number of articles on this. Finally, inflation. Let me put it this way. Last night I finished a chart because I'm obsessive and I'm always updating these. So I have, almost 200 countries. I track them all, monthly data. So the latest reading now for the advanced economies, only about 11 countries, mostly Europeans, have reported inflation through September. All of them, including the US, through August. But the bottom line is the percentage of advanced economies that have inflation rates above 5%, which would have been scandalous, okay, as little as a year plus ago. This is more than twice the objective of major central banks. That share is about 90%. And the last time, can anybody guess, when was the last time we had 90%? Okay, come on, don't be shy. Huh? When? No. 29, no, not that far. Inflation, high inflation. 82. The inflation era of the 1970s had its big culmination in the very early 80s. And this wasn't just the US, this was all the advanced economies. For emerging markets, the share is now, the median keeps going. I didn't get a chance to update this, I apologize, but they're higher for everyone, okay? For emerging markets, we had a big food crisis in 2008, 2009 that hit a lot of low-income countries especially. And so the inflation spike is, you don't have to go back 40 years plus, which is the case for advanced economies to see this inflation. But the problem is that the pop in inflation, and this is importantly here, and this is my last slide, the Russia-Ukraine war, okay? Many countries imported oil from Russia and imported wheat from either the Ukraine, Russia, or both. What if you're a poor household, the largest share of your consumption is food and energy. The middle income households spend the smaller share, and the higher income household spend even less. Across countries, it's the same story, okay? High income countries, more or less, on average, depending on what shares you use, whether you use expenditure data or CPI data, but anyway, around 16% of the CPI basket is the food and energy, I'm sorry. Around, for middle income countries, it's between, mid 20s, okay? Closer to, well, actually for many, it's closer to 30. Depends on whether you look at the average or the median. And for low-income countries, it's more than half. So again, the spike in food prices is extremely regressive. I talked about COVID being regressive. Well, the spike in food prices is another double whammy. And on that uplifting note, I will conclude by saying that what I keep doing again and again and again is a call to the international community to, this time is not different. I mean, this time is different. It's meant to be, as I said, ironic, that things will not sort themselves out, that the issue of debt relief needs serious attention and needs timely attention, because so far we are replaying the same kick the can down the road game that we played in the 1980s. And that basically led to a lost decade for many high indebted, medium, middle income countries. And for low income countries, it was almost 2 decades, because broad recovery in sub-Saharan Africa and other middle income, other low income regions came later. So the international community needs to get its act together. So far, there's no inclination that it's doing so. That's, my uplifting, get your tissue boxes out. So
why don't we open it up to questions? We will try to raise hands. Just while you're thinking about your questions, I do have to put in context for you. I was an MPP in 1982, believe it or not. And you're much too young to understand this, but I got student debt borrowing at 5%, and I could put it in a money market fund and get 18%. Okay, so it's pretty hard for you to imagine the kind of situation Carmen's talking about, but it can be real. With that, questions, I'll start here.
Thank you so much, Carmen. If you could make 5 phone calls to anybody today and you get an hour with them and convince them to do what you think needs to be done, who would those 5 phone calls be to?
What would you say?
Who do I call in the US and China, for starters? Who do I call? Because so for the big players, you have to get the US, you have to get China because they're a major creditor. You have to get France also on board because they're a bigger lender. So if you could get those 3 in, you'd be a long way to dealing with some action. The UK and Japan would also be, your 5, but the critical impasse is that nobody wants to take the first step. And there's a coordination problem and there's a distrust problem. Do not underestimate the problem of issue of hidden debts so to get anything out of the G20 or a G7 plus China, okay, you'd have to have a real willingness to begin to seriously write off debts. Nobody has shown that. Not China, not France, not the US. So, the phone calls, I don't think at this stage are, because unfortunately what happened, and I'll conclude here, I wrote a recent piece for the IMF, I did the Mundell Fleming lecture, and there's a piece that goes through the chronology of a debt crisis. And you get to the write-off stage when you've tried everything else and everything else has failed. So that's my concern. It wouldn't be the IMF, it wouldn't be the World Bank. They're not the biggies.
Thank you for the talk. Other than sovereign lenders, what role do you think private bondholders have to play in helping, with restructuring? And things?
Bondholders. Well, but participating would be a good one for starters, which they did not. The private sector did not. I mean, look, the debt service suspension initiative, which began in the spring of 2020, was at, I mean, remember the world. We don't have to go to ancient history. Remember the world, 2.5 years ago. The initial wave of COVID, the global lockdowns, every indicator falling off the cliff. If during that environment, you didn't do debt relief, so it's, look, for those of you that, are up all night and want to bore yourself to sleep, I suggest you read my Sovereign Bonds since Waterloo. It will achieve that beautifully. But it basically highlights that the dance between debtors and creditors is time invariant. The creditors don't want haircuts. They don't want to take losses. So, the private sector is no different. Now, the private sector has proved that it can go to the table and do restructuring. It did so with Ecuador in 2020, did so with Argentina in 2020, things with other countries like Suriname is proving sticky. I mean, and God knows what will happen with Sri Lanka. And anyway, but it happens. The problem is it often happens rather anemically. So it's still kicking the can down the road. So you get a little bit of a haircut, and then a year and a half later, you got to do it all over again because it wasn't as sufficient. That's the key problem with private creditors, which is not that different from official creditors. Nobody wants a haircut.
Thank you so much for your talk today. My question is about, I don't think most people think that COVID is like a one-off event, right? There's like a greater chance that we have pandemics in the future, in the next coming years, climate change, like all these big issues are happening to us now and in the future, which to me seems like the landscape of development practice has shifted. So what do you think are the new approaches that we need to take to global development to kind of counteract this new landscape?
So the thought process you describe is very much alive and well in the multilaterals. Look, it may not be a COVID pandemic next time, but by the way, the next World Development Report that was started in the tail end of my stay at the bank is on migration. And an important source of cross-border migration are climate shocks, which are, again, regressive, importantly concentrated in many low-income regions. And so the preparation, a legacy of COVID, I would say, is that we need to prepare for whatever, because apart from Martian's landing, which we can't rule out at this stage, anything's possible, but we certainly know that climate shocks are more likely, and more likely in parts of the world that don't have the resources. So the big theme of resilience, which again, look, sadly, you have to distinguish between blah, blah, blah and real, okay? The real part is the recognition that, for example, countries that had better networks for distributing, better social safety nets, that you had a better system for distributing, cash payments at times of stress, we're able to do more. Okay, so part of resilience is building the kind of networks that allow you to provide more support in bad shocks, whatever they are. The other part, which is a very tall order, is, in the realm of, and still very speculative, because again, nobody wants to take a loss, attracting more climate finance to start dealing with what needs to be done on the climate front. And as I said, that's another layer of financing needs that, and your question about bondholders. But what do bondholders want? What, every time I talk to the private sector, which is every week, oh, we love green bonds. We love green bonds. We love high returns on green bonds. So very often what the private sector wants is guarantees. And if the World Bank starts offering guarantees, when you know that the project is going to lose money, the institution suffers a hit on its credit rating agency, which increases the cost of providing cheap money to other countries. It undermines its very existence model, the model of its existence.
Yeah, thank you very much for the presentation. Just one question. Don't you think that there is also a reversal problem in the first world? Because most of the issues that you mentioned, the level of debt, the increase in inequalities, they are also present in our societies. And if this is the case, why do you think that developed countries will act to help middle income and LDCs countries if they are also facing problems of quality of democracy internally, how to fight inequality,
Don't put words in my
etc.?
mouth. I didn't say I thought that, advanced economies would act. And the point I've also been making is, so far, whatever the dialogue is, so far the actions have been missing. And the reason is very much what you say. Why haven't I focused on advanced economies? Well, and you're absolutely right that many of the reversal, in effect, the book that I mentioned by Martin Wolf, which is very connected to this, is about advanced economies and continued economic disappointment. Why haven't I focused on that? Because we have the canary in the coal mine problem. You know, that the greater fragility, you know, that we're going to see before we see it in the advanced world. We see it first in those that are already much more at risk. That's number one. Number two, the advanced economies, notwithstanding all the bad tracking in a lot of the indicators, certainly the debt, the credit ratings, the democracy scales, the whole, still have per capita incomes for the most part that are higher. You know, Italy and Greece are big exceptions, right? Italy and Greece have per capita incomes back to the pre-2007. Okay, if you look at the World Economic Outlook, you see, but most of the advanced economies are either at a new peak or close. And that, again, is about more rope. It doesn't mean that it's not going to go in the other, but it means that there's more rope. That's why. But did I say that I thought advanced economies are ready to? No, I don't. I think that is basically about a call to action to be a constant reminder, but with very limited expectations as to what that can achieve over the near term.
All right, we have time for one more question, and you win the prize, but you have to come get the microphone. I apologize for all of you. The lesson from that is sit in front.
Thank you so much for the conference today. I want to know your thoughts and your perspectives around a political event that is going to happen in the next weeks, which is the re-election of Xi Jinping for his third term, and how you think is going to impact the macroeconomy, because there is these two trends of thought that China is going to continue closing up and decouple from the world, and the other about an opening. So
a baseline scenario, I can't predict election outcomes. I refuse. I mean, it's that and the value of the dollar and the equity market and a few other things are, you know, but my baseline is whatever the outcome, barring tail events, okay? You always have to say barring a tail event. But if the outcomes are, you know, in terms of the balance of power, my baseline is that a lot of the problems that we're seeing are not short-run problems. The slide in real estate prices has not had the drama of the 2008-2009 financial crisis, and certainly we don't have in China the you know, packaging of mortgages and the subprime issues that we did. But I've studied real estate cycles as they relate to banking fragility in many countries over a long span of time, both advanced and emerging. That's a real issue. That's not, and importantly in China, real estate, there is no social safety net to speak of. So it is a real nest egg. So that impacts consumer spending, that impacts confidence. I think the issues of over leveraging, which have been manifest, and they're also connected to housing, especially in provincial governments, is not going to be solved right away. What I'm saying is there are a lot of medium-term over leveraging issues that will take time to resolve. Bottom line, as I said, after the 2008-2009 global financial crisis, China was a dynamic engine of growth for the global economy and for emerging markets in particular. In my view, that's very different from what to expect going forward. So I asked, hence my question of who's going to be the engine of growth. And as I said, barring any tail event that involves increasing social unrest and, you know, barring those tail events, what I've outlined here are some of the elements that I see in a baseline going forward, because the problems that China is having, which are in each country, they assume their own form, but they're common elements. You know, this is why we study financial crises. This is why we study the aftermath of financial crises, and they're common elements, and they don't resolve quickly.
All right, terrific. I want to say thank you to Carmen. We are at the end, and I appreciate